Business owners are struggling as inflation, supply chain problems, and decreased consumer spending eat away at their sales and profits month after month as a result of their inability to compete. In the United States, hundreds of thousands of stores have closed in recent years, and with the start of a new economic downturn, many more are expected to follow suit. Due to the growth of e-commerce, some of America's most well-known shops have filed for bankruptcy and shut down hundreds of storefronts, making traditional brick-and-mortar stores obsolete. While most firms really believe they'll offer something distinctive to their clients, some have drifted so far from their target market that when they realize there is no simple way to get back on track, they are compelled to close their doors. Without further ado, here are 10 of the most well-known stores that are probably going out of business soon. Some of these chains have already closed dozens, if not hundreds, of locations across the nation, or intend to do so by 2022, meaning that we may never get the opportunity to shop at these places again. 1. Due to the terrible process of practically complete liquidation that the company is undergoing, there are only 3 Kmart locations open at the moment in the United States. Sears Holdings, the company that controlled both Sears and Kmart, filed for Chapter 11 bankruptcy protection for the first time in 2018, narrowly averting liquidation. Kmart is a discount retailer chain that reached its peak of 2,400 stores in the early 1990s, but has failed to modernize its stores, allowing bigger competitors like Walmart and Target to steal away a significant portion of its market share. Together, Sears and Kmart have closed more than 3,500 stores and laid off roughly 250,000 workers over the past 15 years, since both brands were sold to their longtime investor and CEO, Eddie Lampert. 2. The Barnes & Noble. Despite being acquired by the British company Elliott Advisors Limited, the famed bookshop chain faltered after the outbreak and declared bankruptcy in March 2021. According to the New York Times, the company's revenue has dropped by 50% over the past 2 years. In December of last year, 197 of its 600 remaining outlets were scheduled for closure. According to Scott Amex, Barnes & Noble apparently loses $10 million in sales per year and has negative cash flow. If consumer trends don't shift, Barnes & Noble will continue to lose money and eventually go out of business. 3. AMC, maintaining its 620 sites spread across the nation, will become more and more difficult as streaming services become more and more popular, even though the company saw its share price soar as it became a meme stock in a historic gamma squeeze led by retail investors. However, its financial situation has not improved enough to justify the size of its physical presence. AMC went on to raise $104 million by selling roughly 38 million of its 200 million shares after warning that it would run out of money last year and would have to file for bankruptcy if it did not secure liquidity. But in December, it revealed plans to raise an extra $100 million because it still lacks funding. 4. True Religion Apparel. One of the many retailers catering to youth is True Religion Apparel. After reducing its total debt to roughly 1/4 of what it was prior to bankruptcy in 2020, the company filed for bankruptcy a second time in response to the pandemic, which resulted in the permanent closure of over 140 stores across the nation. At present, there are over 140 stores that have been permanently closed. The company first filed for Chapter 11 in 2017. 5. In May, Sears, which has only 25 locations left after having tens of thousands in the early 2000s, announced plans to liquidate 7 additional shops this year due to declining annual revenues. The bankruptcy filing is merely delaying the eventual demise of the Sears brand, according to Bill Dreyer, a Wall Street analyst at Susquehanna. We might not have any Sears stores left in the country by the middle of 2023, which highlights the company's precarious situation. The company has not been profitable since 2011, and same-store sales have been declining for 10 years straight, along with tighter payment requirements as well as product withholding from the manufacturers, he said. 6. We were unable to complete our refinancing, and the unexpected change in the operating climate had a significant negative impact on our firm, according to a statement posted on the company website. While GNC stores have been experiencing financial difficulties for years, Industry insiders assert that the internet had allowed a flood of competitors to enter the market. 7. Office Depot and Staples. According to Jesse Harrison, CEO of the Employee Justice League team, the difficulty that office supply stores will face is that one does not need to see the item in person to acquire it. If you need a stapler, you already know what you require and can buy it online. Everyone is aware of what paper looks like, so there is no need to visit a store to examine or try it on. He predicts that companies like Staples and Office Depot will close down over the next few years. In the United States, 198 Staples and Office Depot sites closed in 2015, bringing the total number of these brands' closed locations to over 1,100. 8. According to financial author Stacey Cabrio, Gap, one well-known brand that may cease operations in 2022, is Gap. Their revenue is primarily based on consumer spending at retail stores, which has dropped precipitously in recent years as a result of coveted lockout policies. If they want to stay in business for a very long time, they will need to innovate and focus more on the internet than on retail. One casualty of this is their decision to stop paying rent for their remaining stores. 9. JCPenney lockdowns and stay-at-home orders had a terrible impact on the retail industry, and some claim that JCPenney, another legacy brand that may be discontinued, was finally doomed by the epidemic. According to the principal of C Street Creative, the company had just about 600 physical stores left standing and a shrinking customer base, adding that JCPenney has already experienced its share of upheaval. 10. Since pricey labels left vogue, Abercrombie & Fitch has struggled. More lately, it has also had to deal with the fallout from inflammatory comments made by former CEO Michael Jeffries. Since declaring bankruptcy for the first time in 2008, Abercrombie & Fitch has seen a steady fall in its profit margin and retail footprint. In 2020, the company eliminated 137 locations, and in its most recent earnings call, it announced plans to close up to 60 stores in the United States, based on analysis by Deutsche Bank, Amber Kananga. The company's prospects are bleak, and it's highly unlikely that Abercrombie will be able to maintain its gross profit margin in the face of the fierce competition in online retail, according to what she wrote. The middle class's stagnation or collapse as a result of inflation and rising interest rates. After meeting their monthly responsibilities for necessities, many in the middle class have seen their spending power decline to the point that they have little left over. Due to the ease of internet purchasing, middle-class Americans are increasingly choosing discount merchants over department stores that carry high-end brands. Online shopping offers several advantages, one of which is the convenience of having your goods delivered right to your home. According to UBS study, 80,000 more businesses are expected to close their doors by 2026, bringing the total number of businesses that have shut down in the last 5 years to hundreds of thousands. For each business that closes, dozens, hundreds, or even thousands of jobs will be lost. The collapse of America's mega corporations has left the nation's economic landscape in desolate condition. We value your time spent watching this video and want you to leave comments below with your thoughts.